Well, I think it's only one print, so clearly,
Right.
it's not a trend, so to
Right.
speak, as yet. I think as far as the Fed's concerned, but I do think it probably gives them some license to start easing off now. So, for example, rate hike odds for December being 75 basis points. I think that's significantly reduced now because of this number. So, I think that if this is the start of the trend, which I think it very well could be, I think we see lower interest rates from here. If you're a consumer hoping for that trend to roll over, we've certainly seen it. If you look at the numbers, these anomalies like used cars, used car sales, used cars falling 2.4%, month over month. Housing, we've seen. Housing is already in a recession here in the United States. Housing has rolled over first. The direct effects from the Fed tightening, from mortgage rates going up, from just general financial conditions tightening, makes it much harder to get financing if you're looking to buy a car, if you're looking to buy a home, or even we saw apparel come down with the buy now, pay later type. Well, I think the focus is going to be still on reducing interest rates. I think the key is going to be still on reducing inflation and bringing that inflation back to target. I think the interesting point is really what inflation number are they really focused on? Because we've got headline inflation,
That's right.
we've got core inflation, we've got a number of different numbers that ranging from sort of 7-8% down to 6% and lower if you're looking at service inflation. So what number are they really focused on to bring that back down to trend? Because 2% clearly is a big way to go.
Right.
I think that the Fed and it's just a classic. They can only look in the rearview mirror.
Right.
So a lot of this data lags, as we know, and so it takes some time before those effects filter into the economy. We start to see it really visibly. Take hiring, for example. The announcements that we see, that's just the tip of the iceberg, because as we know, the majority of suddenly corporate hiring and or firing decisions come at the end of the year. And these are obviously very well staged, managed through review processes and things like that. Then even once people get fired, once the announcement's made, it might not show up for another few months once notice periods and things like that are accounted for. So there's a lot of lag in this. I think that there definitely could be a rally, and it's probably more likely to be a rally than not, just because of what's happened this year. But the rally is going to be largely technical based as opposed to fundamental. We've still got huge amount of problems in the economy, and I think the economy, it gets worse from here, not better. But certainly because of what we've seen this year and the amount of pressure on the market, I think from a technical perspective, we could be set up for an end of year rally. I think it's also kind of a function of what you just mentioned, that this era of excess liquidity has come to an end. And a lot of these excesses that we saw and perhaps took for granted as a function of that are also coming to an end. So maybe it's just one company, but the fact that he's letting go or has let go of 50% of the workforce sort of begs the obvious question: how many other companies are out there that people could do the same thing and it not affect the customer experience? Because a lot of these companies, have been really enjoying massive success of this excess liquidity that we've had in the economy and zero interest rates. Now that that's really come to bear, some of these incredible projects, things that people could do and afford to do, when money was free, no longer the case. So I think we can start to see a big contraction. When it comes to gold and obviously lesser extent silver, I think it's really quite simple for me this year. If you look at the performance of gold in US dollars, because gold is priced in US dollars, if gold is an antidote to the dollar, to fiat currencies, it's performed badly this year because the fiat currency has been so strong in the dollar. But if you look at gold in other currencies around the world, the British pound, the yen, etc., you'll see gold's put in a good performance this year. In some cases, gold has done extremely well. And so when you're in another currency other than the dollar, and the reason to hold gold is to protect against a fall in the fiat currency, gold has done that job. The one currency that's bucked the trend clearly is the US dollar because of the interest rate rises in this economy. And so that has hampered gold. But I think we go back to, is the dollar peaked? and certainly the dollar's been on a downward trend now for the last sort of month or so. If that continues, or indeed it just pauses from here, I think we see the rally in gold, and maybe we've already seen the gold bottom. I think for a 2000 type scenario, we have to see some broader dislocation in the economy. That I think probably the most likely thing at the moment comes from a mistake from the policy, particularly from the Fed, leading to something major breaking in the economy. This is a year where everybody is down almost. So the 60-40 portfolio, which you can say doesn't include gold typically, but this is probably one of the worst years on record going back to the Great Depression. So money managers are really scratching their heads as to what to do. What is it that they can do in this environment that's actually going to work and make money for clients? Equities have not worked, bonds have not worked, and certainly other assets like gold, on an absolute basis, people have lost money this year. And I think in that environment, when portfolios are down, it's really tough. I think it's more of a question for me, or more of a case of what we've seen from central banks consistently over the last, let's say, 10 to 15 years, which is, we're not talking about sort of Western central banks, so to speak. We're talking about other central banks around the world that are trying to manage currency reserves and create a diversified portfolio largely away from the dollar. And I think in an environment or in a world where the dollar's become so strong and you're importing inflation, having an allocation to gold has become a lot more important for some of these central banks. I think, again, it's largely down to what we're seeing in the commodity spectrum or across the commodity complex more broadly, which is these supply concerns or supply constraints that we've had in the market over the last sort of certainly 15 to 20 months, but exacerbated by years and years of underinvestment. There's just no quick fix for it.
Yeah.
And the bottom line is that a lot of these other variables to bring inflation down, for example, can be brought into line, and some markets are easing. But fundamentally, when you're looking at a metal like copper, that's just so important to affect this energy transition that all the major, certainly Western governments want to enact. And so finding supply of copper and getting supplies of copper is going to be increasing, or is going to be a big challenge over the next decade. Symptomatic of the ending of this excess liquidity era. And I think we've got to ask ourselves, how many of these things could be possible now? If you were to start cryptocurrencies in this environment where money now has a real price, would it be possible? Could it even survive? Could it exist? And I think you could be talking about cryptocurrencies as one of these things that could only have happened in this environment of excess liquidity. Well, I think people are already sounding the death knell for cryptocurrencies, already because of not just what's happened with FTX, but if you think about, I think it was 2014 was when Mt. Gox blew up,
right,
which was sort of the first major exchange that was, I think at the time, was the leader in cryptocurrency exchange, or leading cryptocurrency exchange. And 8 years on, have we really learned any lessons? And FTX goes down. It's really probably deserves its own show, because it's an incredible story in terms of how this has happened, and clearly it's not all unfolded as of yet. But I think I sort of go back to this idea that is this really the end of the crypto industry as we know it? I think that a lot of people now are going to turn away from crypto.